G'day everyone, thanks for joining us for this WIP webinar and thanks for joining Josh and I over at Xact Accounting. Today we'll be going through WIP, work in progress, and why you should care about it. So a little bit about us first. So Josh and I work for Xact Accounting and we're building and construction specialists. So we almost focus on building construction exclusively and we have a lot of experience in this area. Josh and I are a little bit different as far as accountants go. So Josh's specialty is tax accounting and qvcc accounting compliance. So anything to do with tax accounting, qvcc, MFRs or anything like that at all, Josh is the person you want to speak to. Now from my side, I keep away from that where I can and I talk profit. So I look after the CFO advisory division over at Xact Accounting, and anything to do with profit, margin, making more money, that's my wheelhouse. So what is WIP and why are you here? So WIP's really hard to master, but it's really, I guess, really worth the effort. It takes a lot of effort and energy to get it right. So look, you might sort of kick your toe with calculating it, but it's definitely worth the effort as far as getting clarity over your business. If you're not using WIP, you really are running your business with a blindfold on. WIP really gives you clarity month to month because you should be calculating this month to month as to how your business is performing and where you're actually at. What you don't want to do is when you sort of fire up your P&L or your profit and loss and you try and average 4, 5, 6 months worth of activity and go, oh, look, yeah, maybe if I sort of do that back of the envelope calculation and I guess add that claim in, pull that claim out, and your profit's going loss, huge profit because you managed to flush through all these claims. You don't want to sort of try and average 4, 5, 6 months or wait for all your income to land for a project and all your costs to land for a project. And where I thought I was going to make a 20% margin, and you've landed at 6 or 7, you don't want to wait that long to see how you're traveling, and WIP really gives you clarity around that. So if you don't have WIP, you're really riding a roller coaster, and it's a pretty emotional one as well. You see a huge loss, I guess month to month, back to back, and you might have all this sort of money coming in and bills coming out, but you can't really get clarity as to where you're actually sitting. You might have this back of the coaster or back of the envelope calculation. Oh, look, I've had these 2 months worth of WIP. The bank's pushing back a little bit here for this huge claim I'm trying to get through. WIP really plugs that gap and really plugs that uncertainty, which we'll get into a fair bit of detail later on. And WIP, get it into your reporting now. It'll really help you sleep better at night, give you a lot of clarity on your numbers, why run your business with a blindfold on. And best practice around this too, guys, is doing it monthly. Try and avoid doing it at the end of the year for MFR and compliance and the rest of, which is really, really important. But best practice is you do this monthly and go, right, how do the numbers fall for the month? Am I trading profitably? Am I not? You don't want to wait 6 to 9 months, or wait for 30th of June, whenever your MFR reporting, I guess, frequency is, and go, geez, I hope I pass. This really lets you know whether a bus is coming or whether stuff's all right. It'll help you definitely help you sleep better at night.
Yeah, absolutely, Dan. 100% agree. And qvcc, appreciating how it folds into qvcc is the direct link into your minimum financial requirements, which we'll touch on a bit later. But if you don't have WIP, you really do put your license and your livelihood at risk. And without WIP, you might find it actually hard to explain to external stakeholders like banks and financiers and shareholders in some cases that you're actually making profit. So if you don't have WIP in there, you could be, showing a loss in some cases, or a far deficient profit position, which banks won't like to see. So WIP is commonly the missing piece in that equation.
So we've touched on WIP lightly, what it is and why you should care about it. I mean, A is obviously clarity in your business, and also equal A is obviously for your qvcc compliance so you can continue to trade. So now we'll get into the meat and we'll put our accountant's hat on and we'll just jump into how we calculate it. So we're going to look at this from 2 lenses. So from my side, as I introduced, I'll be looking at it from a profit perspective. Is your business trading okay? I guess you'll really want to avoid that sort of 6 to 9 month profit averaging. And you want to fire open your P&L for April and go, yep, I'm on track or I'm not. And then you can sort of pivot and adjust around that. And then Josh very kindly will look at it from the qvcc compliance perspective and why you should care about that. So I will jump out of this. So just bear with me while I change gears here. And we'll jump into our WIP calculator. So a few of you who might have looked at this calculator already might have already downloaded this from our website. So well done to you if you've already jumped in and had a crack at it yourselves. But this video will help you sort of navigate through how this works, because there's a bit of complexity in this calculation. I mean, a lot of it is calculation in the background, which have flagged across the top, but I'll sort of step you through it now anyway. So the way WIP works, or I guess the way this sort of spreadsheet works, is that you need to list down all your current live jobs on the go at this stage. So whether it's job number or whatever it is from your source CRM, whether it's Build Xact or Procore or whatever it happens to be, just list down all these jobs as they are and just enter the anticipated job start and end dates. The next section here, all the way across, is your quote. What did you quote to make? What was the contract price on it? What were you quoting to spend? And ultimately, what profit were you looking to generate at the end? So this should be relatively straightforward. I mean, if you spend a lot of time sort of, I guess, the nitty gritty in your quote and getting it really right and really accurate, that should be pretty straightforward. Look, hopefully you put heaps of science behind it so you can pull these numbers out pretty quickly and pretty easily. And then each month too, when you are measuring this, you should only have to do this section once. So when you sign like either a new project or a new client, or you commence a new project, you just add an additional line here, and then just be really careful around variations. So if you are doing variations in there, just make sure you update that column as well. The next section here, which is going to be a fair bit harder, just depending on how well you stay on top of your data and I guess the data accuracy, this is all the calculation section, and I'll step through that in a second. And then right at the end, which is probably the number you're dying to know, is your WIP. And sometimes this can be positive or sometimes this can be negative, but I'll touch through that in the end very shortly. So I'm just going to work left to right on this, and particularly I'm just going to work on this 0001 job. And I'm just going to explain how this works, where the calculations come from, and I guess just some of the sensitivities around this as well. So this company here, XYZ Big Money Constructions, has jumped in, put down all their projects, and we've gone, right, for this project here, this is the job. So we grab this from Build Xact or Procore or JobMan, wherever it's come from, the start and anticipated end dates. And we've gone, right, what is the contract value that the client signed, including GST? So it's $500,000 or $550,000, including GST, and you just enter that as a flat figure. Next one is contract variations. So this is income. So where you're charging the client additional money for contract variations, you put down whatever the sum is. So in this case here, it's $11,000, and it's just a data entered input. Now, so the total contract value to you, so revenue being generated, is $561,000, which is simply the sum of these two. So this spreadsheet calculates that for you. So that's how much it's worth to you, including GST. But as we know, unfortunately, you don't get to keep the GST, so we unwind that out. So the revenue to you is $510,000. So you should be able to get that from your source CRM, Build Xact, Procore, or a spreadsheet, however you sort of build your quotes up. The next piece is, well, we covered the income, now we need to cover the cost. So you should be able to pull this one from your quote, again, source CRM, and go, right, well, we're due to make, or I guess the revenue side here is $510,000. We're due to spend $410,000, so layer the supervision, however you build this up, and we're due to make $100,000 out of it, or 20% gross margin, which is great. Excellent. That's what you're planning to hit. Now, when you fill these out for the 3 lines there, we'll push across to the next section, and when we start actually getting into the nitty gritty of WIP. So usually the best place to start here, and this is generally best practice, and if you're doing job costing, you should be able to jump into Xero or MYB or Reckon or whatever it is and pull out a job by job cost for that project. So you should be able to pull out a job by job profit and loss and just put your start and end dates relative to this spreadsheet, or until the start time. And what we're trying to do here is we're trying to capture all the costs that have come in against that project, whether you track it by project number or job address, whatever it is. Hopefully every bit of cost that's coming in, especially in direct costs, so your cost of goods sold, you can capture there. Now, the next step is, again, depending on your data hygiene and how effectively you're tracking all this, is going, right, well, this is what my accounting software is saying, 170 grand for this job, 23K spent for this job, 130. But you might know in the back of your mind that when you're running your job by job P&Ls, that there's 50 grand worth of cost that's unallocated. So either the bookkeeper hasn't entered it right, or you haven't had the time to enter it correctly, but in the back of your mind, oh, actually, I've done the driveway. I know I've incurred all the costs that are subcontracted costs, but I just haven't put the correct job number in. That's where you put that entry in there. Whereas if you can't find it in your software system, but it's niggling at you, you gross it up and you put that figure in there. So in this case here, they've actually spent $220,000 on this project. So that's total costs incurred at the end of February. The next piece we then jump into that we want to know about is going, well, out of the 220 grand that we spent, what are the cost overruns? Well, we know we've overspent. So for example, we might have been calculating the concrete for the driveway. We might put down 2 cube and it's coming at 8, but you just miss the cost or whatever it happens to be. We want to try and measure the overspend or the overrun. So you might have your source system or your CRM or your own internal reporting that will calculate that for you. But out of that 220K for this project here, we know we've overspent 65 grand in that, and that's a pretty important piece of this calculation. So we know that our original budgeted cost for the contract was 510, and we're going to make $100,000 profit from this. Based on our calculation here now, our new cost base, because we know we've overspent 65 grand, we've either received a large invoice or got our calculation out for some of these entries, we're now going to spend a total of the original budget plus your overruns. So the new cost base for this project is now 475,000. And unfortunately, when you go to recalculate your profit, because back in the day, we put the quote in the tender through, we thought we're really diligent, we're going to make $100,000 or 20% margin. But as of right now, as of the end of February, we've overspent 65. So we've torn up that margin, and now we're going to make $35,000 or 7%. So you're starting to get a bit of a feel here, which again isn't great at all. But doing this process here gives you clarity as to where you're sitting. You're sort of remeasuring your costs, you're remeasuring your overruns, and going, right, we've torn up a fair bit of money here. 65,000, our margin's decreasing. How do we sort of pull this project under the microscope and either turn it around, or you might be able to push through variations with this overspend. But at least I guess you aren't sort of putting your head in the sand or sort of defaulting back to that old position when you look at your P&L and trying to average these periods and those periods. A lot can happen inside a month too. I mean, you might forget about this. It's just really important to keep the lens on the business and go, right, where's this actually sitting? Because 7% isn't very fun at all. So pushing on here for the rest of the WIP calculation. So the method we're covering here is the cost method. So what we're saying here at the moment is we have incurred, we are due to incur $475,000 worth of costs. So we're no longer incurring 410 because we have this overrun. So now we're going to incur 475. And we're going, right, well, we've actually spent the costs in your system plus the costs that you can't find in your accounting package. So we're now incurring 220. And then what is that as a percentage of the total? So in this instance here, we've actually incurred 46% of the contract cost for this build. So now we're going, right, we're 46% of the way through, we're 4% of the way through here, and we're 81% of the way through here. And this is a calculation field, so don't worry too much about getting that really right and really accurate. It's this section here you need to spend a lot of time and attention on, because if this section's, again, rubbish data in, rubbish reporting out. So pushing on across now, so we've covered all the costs here. The next bit we need to get really accurate, and which should be really easy. Everyone loves money coming in. Either jump into your accounting system or I guess build Xact Procore, whatever it is, build a trend and pull out what have you charged the client as of the end of that month. So in this instance here, we've charged the client $200,000. But when we go, hey, we've actually incurred 46% of the cost. And if you apply 46% of the cost against the revenue base of 510, you should be entitled to 236,000. So the WIP calculation here goes, well, look, you've sweated out 46% of the effort. You've only managed to build 200, but if you had 46% of the income, you should be at 236. So you need to introduce positive WIP of 36,000. And then and then I won't jump into these calculations now, but this instance here, this is quite the opposite. They've incurred 4% of the cost, but however they've structured their contract, they might have front loaded some revenue with the slab pour or whatever it happened to be. So, the slab pour might have been 10 or 15 grand, but they managed to squeeze out 70 grand from the bank. You've actually front loaded your cash because you've gotten more cash in than what you've anticipated, but you haven't done the effort and the energy to be entitled to it. So you've actually entitled to, based on the cost base, 28K. So you front loaded your cash, which is excellent, but don't go spending it. That's what this means. You've still got a fair bit more cost to come in. And then this one here is positive. So in this instance here, we've gone through it. And again, the first time you do this, guys, the first one will always be the hardest. But once you sort of build the discipline and I guess you're a bit more accustomed to job costing and job coding, your system should be able to sort of spit out the number for you. And it's just a formality. And at least this way, here, this number here means you're entitled to an additional $99,000, which you haven't billed or pushed out, whatever it happens to be, but you've done the sweat, you've done the effort, but your revenue is understated in your books. in which case your profit will be understated. So bringing this all together now, we've done the calculation left to right. We have our jobs. This is our sort of budgeted quote piece. You know, I guess the revenue you plan to make plus variations, your budgeted costs, your budgeted margin. This middle section here is these are the costs that you're starting to incur. It does a recalculation of where your margin is sitting. Obviously, this one here is really bad news, but you want to be able to sort of measure and I guess give it attention, not wait till the end, especially if you're only halfway through the build and it's only going in one direction. At least you can plan around it. And then this number here right at the end is your WIP calculation that you push into your ledger or your P&L. So bringing this together now, I'm going to take you through a business that has no WIP, and I'll look through the lens, I guess, of the profit perspective, you know, what it means, you know, how does the profit sort of jump around, and a business that does have WIP in. And then I'm going to change gears, hand it to Josh, and he's going to focus on the qvcc compliance, particularly around the balance sheet. But I'll push through this section pretty quickly. So this here is a P&L of a business. I mean, we only go down to gross margin here of a business that doesn't have WIP, and this probably looks really common to a lot of you. So just working from top to bottom up here, you know, so sales have gone through, you pushed out claims of 204 in October, 170 okay in November. You know December is really tight. I guess you have like leave and all the rest of it, so you really try to squeeze as many claims as you can before you go on leave. January is a bit of a catch up on the stuff you missed in December, and you might have sort of forward claimed a few things as well. And then February is usually a bit quieter and a bit tighter, and that's pretty common from what I see. Now, when you look down at the profit, which is what you guys get to take home, and this is really common, you have huge loss here, huge loss here, huge profit, huge loss. You know, so and then this is the rubber band effect: loss, big up, and down, and that cycle generally continues depending on how much money you can get away with charging the banks. This is a nightmare. I don't know how people run businesses this way, but when you haven't been exposed to WIP accounting before, it really plugs this gap and it really normalizes this position. And you shouldn't have to wait 6 or 9 months down the track and go, have I actually made money? WIP plugs that, and I'll show you this now. This is a business that does WIP. So as you can see here immediately from the graph, you know, this is your profit bouncing around all over the place and you don't really know where it's up to. This is just starting to have a bit more sanity and a bit more rationality behind it. It's a bit more predictable. It sort of bounces across nicely. Ignore cash. You know, cash is separate to profit. But look, generally if profit's okay, cash will generally be okay as well. So this is a business that does WIP. The margins down here are a little bit predictable, a little bit repeatable. You're not stressing as to why, you know, huge loss here and huge loss here. Your WIP accounting gives you clarity that your business is traveling okay, or if it's not, at least it allows you to plan for it and not wait 6 or 9 months down the track, average it. Go, actually, for those 9 months, we traded a loss. This gives you clarity so you can plan now. So this business here is actually trading a little bit okay. You know, 19 and 18% margins, a bit of a swing up just for a timing of some claims. But as you can see, you know, the moral of the story is that it is predictable. So with this $99,000 number that we calculated here before, when you do push this into your P&L here, because keep in mind work in progress is if you've incurred the cost, you want to pull the revenue recognition into the right period and go, right, at this point in time, ignoring pushback on banks and clients and all the other noise, if it was a perfect world, if I've done the sweat and I've done the work, it pulls the revenue recognition to the right place and go, right, this here and now is how I'm trading. And all the big guys do it, every single one of them. If you jump onto the ASX and you buy shares or whatever it is, all of them do this. Every single one. You know, they don't wait 6, 9, 12 months, 2 years for the larger projects. They all do this. This is absolute best practice. So here's your work in progress closing entry here. So just lightly touching on this section, it's exactly the same figures, 204, 117. So this is invoices that have gone out the door. But what this section does here is go, well, we've done 204K worth of billing, but we still have another 115K worth of effort that we haven't billed for. So when you aggregate all these numbers together, this is the true position as to how the revenue is tracking. And WIP does give you the clarity behind that. So when you go down to the bottom and month to month, am I doing okay? WIP really plugs that hole. And I think that's about it for me. Josh, I'll flick over to you.
Yeah, thanks, Dan. So we're looking at this with a different lens now, with looking from a qvcc perspective, and qvcc quite heavily focus on what's on your balance sheet. So there's 3 key elements that, you know, as a refresher, that qvcc are interested in. They want to know the revenue you're turning over and making sure that you're not exceeding the amount you're licensed for. And that's then dictated by two other metrics, being your net tangible assets and your current ratio. Now you're looking at this sheet here, quite simply, so we look at net assets here, and we'll look at this as the example. So net assets, or net tangible assets in this case, is quite simply all your assets. So what's in the bank, what your customers owe you, quite simply, less all of your liabilities. So quite commonly, they're going to be your subbies, suppliers, tax as your liabilities. So those two numbers then net out to a net asset position, which is what qvcc are mostly concerned with. So as you may know, all licensees need to have a sort of minimum financial requirement from a net tangible assets perspective. So let's look at WIP in that sort of context. So the first thing to clarify is that work in progress, when actually in financials, is actually a recognized asset. So you've got an income item in your profit and loss, which Dan looked at. The other side to that is actually an asset on your balance sheet. That's the relationship between WIP and financials. So if we look at this example here, so just sort of modeling what impact not having WIP in your financials could have from a qvcc perspective. So let's assume this licensee requires 200,000 net tangible assets. So i.e. qvcc want to see 200,000 sitting here at all times in your financials. Now, qvcc do recognize that sometimes net tangible assets don't always perfectly stay at that level all the time. So they do allow a 30% drop in your net tangible assets before they have a problem. So we will model that position. So we'll look particularly around here. So you can see this trend of a business that doesn't have WIP in it, sort of showing over this sort of period here, looking a little bit unhealthy. In some cases, it's actually negative. So negative meaning you've got more liabilities in here than what you do assets. So because qvcc can trigger an audit for various reasons, and one key reason is, look, you're in a sort of fairly fast-paced, a lot of moving parts industry. Say for whatever reason, one of the subbies wasn't paid and you've just missed it, and he's not happy about it and gone to qvcc and reported a monies complaint, as an example. And that's one of the fastest ways for qvcc to come and actually ask the question on, how are your financial requirements looking? So say you're in a scenario here, sort of between October and November, where qvcc slap an audit on you. So they go, show us your financials. And so you'll know from your qvcc license that, well, I know my license has to have 200,000 net tangible assets, but particularly at this point, I had 9,000, just under 10,000, and actually go negative here. And so if you provide those financials to qvcc, they're going to have quite a big problem, and they're going to be looking at potentially, if you can't sort of address their concern, actually provide an MFR that satisfies their requirements, they may even move to suspension on your license because of minimum financial requirements. So you don't want to be in this hot water here where qvcc call an audit on you and you can't prove that you've got the net tangible assets, and you can't even prove that you're still within the 30% drop. In this case, you're well off your minimum financial requirements at this point. And that could put you in a lot of hot water. Your stress levels will go to 11 out of 10, and you really don't need to be dealing with that sort of pressure. And so that is simply, in this case, because of a lack of WIP in the financials. So this is the exact same scenario, same business that Dan was looking at, without WIP. So if we now jump to a scenario where we have WIP in, and we can see here, we've overlaid it here. So we've got the exact same WIP numbers that Dan has in the profit and loss overlaid into your balance sheet. And so you can see a much healthier position immediately. So it doesn't mean that WIP solves every problem ever, but you can definitely see here an immediate, much earlier on improvement in financial position for the business by actually just having a real asset of WIP booked in the financials. So if you're dropping into hot water, so that October, November position again with qvcc, and they want to audit you, well, particularly in November, you can say, well, yes, I haven't met my 200 at this point, but I'm actually still within that 30% leeway, so it's all good. And then you can easily show after that period that you're well and truly in the green, in the safe level, and you're meeting your financial requirements. And it's quite simply because you've actually taken the time to calculate and book an incredibly important entry being WIP. And so you can see on that chart over to the side there as well, similar to the profit and loss, you can see that it's got this linear, predictable pattern to your net assets. So profit folds directly into improving your net assets. So you're profitable, your net assets will increase naturally. And so having WIP, as you can see there, is just so critical in there, and you just don't want to be in a scenario where you can't explain your financial position because you don't have WIP in there. So that's why we definitely push for folding WIP into your business regularly, particularly if you're at a scenario where in your head you're at 30 June and the position is not looking good, but you know that you're going to be profitable in July and August, but that's not going to help you for qvcc reporting.
That's awesome, Josh. Thanks for that wrap very much. I mean, the focus here, everyone, is clarity on your business. And look, if you're calculating WIP, you can almost have a bit of a two birds with one stone. One is your qvcc license is okay and trading okay, and the other side is knowing whether you're trading profitably. Regardless of all the noise and the bangs and pushbacks, from troublesome clients, it just gives you that cut through. And if you're not trading, profitably, at least you can act on it. You can act on it now. You have to wait for 6 months. Try and win another job. Robbing Peter to pay Paul to keep your cash flow high, whatever it happens to be. It's just all around knowing your WIP. If you're knowing your WIP, you'll know whether you're making money or not. The other big one as well, whether WIP is positive or negative, and I'll touch on this right at the end as well, just on like a little graph here. It's okay to have negative WIP, just as long as you understand what it means. Because commonly, if you have negative WIP, it means you forward claims on your claims progress, which is good, which means you've had more money come in than costs incurred. Just don't go spend it on a jet ski or something else. Just really understand what the WIP tells you. And the other big one as well, which I've just touched on, I guess, is clarity in your business. Is your business safe? Is it profitable? Is it still growing sustainably? Josh touched on that. I guess that's sort of like a linear progression with your net assets, and hopefully profits doing the same. You want to make sure that's, I guess that's safe, and you apply a lot of science behind your WIP so that you can continue to provide for your family, and your business is okay.
Yeah, and look, you might be sitting here wondering as well that, Dan, you've just added 100,000 into my profit on my P&L. Does that mean I have to pay tax early now on that? It's a misconception, and the very quick short answer is no. It doesn't mean you have to pay more tax. It is purely an accounting entry. So it follows that what's in your tax return and what's in your financial statements don't have to say the exact same numbers, because they're two very different concepts. So WIP, you just basically don't even think about it as a tax problem. Having WIP in there as well, though, you'll see that when WIP's in there and you've got this nice predictable profit figure in there, it means that when you're looking to gain access to funds and bank support, then they will look at the figures and they'll understand it. They'll like the figures because they're predictable and they can see what's going on. And just like you'll actually know what your figures are. And then that overlay on that example for qvcc, having it in there means that you can confidently be able to meet your MFR requirements, particularly if the business is operating overall pretty well, other than timing. So WIP takes that timing up and down roller coaster out of it, and so you don't want WIP to be the thing that actually fails you.
I just wanted to bring this all together right at the end. I mean, we sort of talked about WIP, the detail behind it. I guess you want to make sure that your business is trading profitably and, hand in hand, obviously keeping your qvcc license safe. And especially if you're doing a month on month as well. I mean, if you're doing it, I guess at the tail end of October or November, and say your WIP isn't that great and your profit's not that great, at least you can pivot and go, right, how do we sort of squeeze a bit more margin out? Am I not pushing through the right variations? What have I missed? And that way you don't sort of get to, I guess, your MFR reporting period and go, oh crap, how do I fix this? Because usually by then, I guess you're in a fair bit of hurt. The other piece as well, I just wanted to helicopter view this section, and I just wanted to talk about cash balance versus your WIP balance, and just what that means, particularly if you're looking in your business, or I guess working on your business and sort of fishbowling in, and go, right, well, how does my cash and my WIP balance sort of work with each other? So what I commonly see is most builders I work with, and it isn't best practice, but they generally have lower cash balances, but they usually carry fairly high and positive WIP. So what that means is that they're generally sort of struggling to pay bills on time. They have this high backlog. They've done this effort, incurred these costs, but they have all these claims. They either sort of push to next month, or there's a dispute, or you know, that's, I guess, the sort of tail end of the claims process as well. So all their cash lies towards the tail end of completion, but they're constantly chasing their tail, but they're generally okay with cash. But it's not a very fun position to work with. You're constantly looking on the back of the envelope, back of the coaster, and rerunning your own numbers all the time. You know, where's it up to? You know, can I get this payment early? Whatever it is. And I see a lot of builders operating in this section. Although it's sustainable, and as long as you're sort of putting your WIP in and you're sort of trading okay profit-wise, cash, you're always stressed, which isn't fun. I mean, cash is like oxygen. Your business definitely needs it to breathe. Where we try and coach most businesses through is going from here to here, where there's a high cash balance and high WIP. So what that means is that you're paying your bills on time. You generally don't have any ATO debt, or, you know, if it is, you know, it's very, very little, it's minor. You have a bit of a war chest on the go at the moment as well. You don't try and push back subbies and contractors. You know your margins, you know your WIP, and you know things are generally going to be okay. I mean, cash does generally get a bit tight around BAS period or super period. You have those big cash chunks that exit the business, but it's much better than being here. Cash is generally okay. If you're in this quadrant here, you're an absolute rock star. And I see very few businesses operate here, but generally you have high positive WIP and you have high cash as well. So what I didn't touch on here is that you have a high cash balance, but you have a low negative WIP. So basically you've aligned all the effort and sweat that you've done, and you managed to push out a claim for it at, you know, I guess at about the same time. So I guess you're basically on par. Where you want to try and get to is this rock star sort of territory where you have high cash and you have high WIP. And what that means is that, you know, you have 3 to 6 months worth of operating cash flow in the bank. So say your overheads are 300 to 400 grand. For a 3 or 4 month period, you have that loose cash sitting there. So ignore GST liabilities and all the other stuff, but you have a nice fat war chest there going, look, if something catastrophic happens, another round of floods, whatever it is, you know, you can continue to pay for rent and overheads and software subscriptions, pay yourself as well. You know, you can sort of continue on with that. This is a really uncommon area to operate in, but one that you can easily get to over time. It's just a lot of discipline around that. Now, if you go away and do your WIP calculation, and you find that your WIP balance is low and negative, or, you know, you have a huge amount of negative WIP, which means you've managed to get all this cash in early before you've incurred the costs, but your cash balance is low as well, like you're really stressing about BAS and super, your things are critical, absolutely critical. If your cash is low and you have low negative WIP, you're in for a fair bit of hurt. Yeah, definitely reach out for help, whether it's us or your accountant, whatever it is. But yeah, things are absolutely dire. Just be really careful of the relationship between your cash and your WIP when you're calculating it. So where to from here? We'll be making this recording and this tool available to you all, I think immediately is the way this will work. And if you have any questions around it, you know, definitely feel free to reach out to either of us. I mean, our details will be stapled at the bottom of the link and on the website as well. Definitely go away and have a crack at doing this. It's really hard to get WIP right the first time around, but similar to exercise. I mean, the more effort and energy you put into it, especially your data and your hygiene, the easier it will become. But definitely have a go at doing it. I can't stress enough, don't put your head in the sand and sort of hope come 30th of June stuff's going to be okay. This will really help you sleep better at night as well, and will give you clarity on your business too. And then especially for your WIP as well, you know, parachute out of your business, run a profit and loss, and then just make sure it makes sense. You know, how is your cash balance versus your WIP? Are you trading okay? Is the calculation looking pretty good? What does it say? What does it mean? What's the story? And I guess the big thing we want to hammer here too is that you're not alone. This is something that is critical to get right, and you really need a specialist to make sure you're safe and compliant, and then your numbers really make sense. Both obviously for profit and for qvcc compliance. WIP for us, you know, is really easy in theory, but we commonly find it can take months to get right, especially on my side of the fence too. I guess a lot of it's behavior coaching. And look, especially if you're doing it by yourself, you might be a bit of a DIY, or you might be having your bookkeeper, or I guess like a better half helping you out. It can be really overwhelming at the start, but I promise it's well worth the effort. You can go to bed or, you know, go to sleep at night knowing that at least you're trading profitably, and I guess your license is safe, not to get to 30th of June or 31 December or whatever it is and go, oh, geez, I hope things are going to be okay. We've jammed a fair bit of content in here, but WIP's really only one part of the story as far as running a business and best practice goes. You know, there's a whole heap of other aspects to ensure your business is running commercially sound and you're extracting as much profit as possible. So definitely tag along for more of these webinars to sort of touch on a few more areas. And that's about it from us. Look, we really appreciate you coming along. Yeah, reach out to us if you have any problems at all. Again, we specialize in this area, or if you're with another accounting firm, definitely have these conversations. If you're not folding WIP into your day-to-day routine, or, particularly monthly, is how often I recommend measuring this, because then you can see the bus coming if there's any sort of hurt on the horizon, or it will help you sleep better at night. You're making the money you thought you spent, I guess you set out to make. Your quote said you're going to make a 20% margin, and you put your WIP in, your business is running at a 20% margin. Gold star, well done. Thank you very much.